Today we're going to talk about breakouts and pullbacks and how they can help you form a bias for your trading session. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Today we're going to be talking about breakouts and pullbacks and how they can help you form a bias for your trading session. So one of the things that I look for each and every day is the peak formation low or peak formation high from the previous session. If the market has had a down close day or an up close day, Friday, Monday, we talked about the initial balance yesterday, the peak formation low or high can help us develop a thesis for our trading session. And one of the things that I've mentioned earlier is every time the market moves 25 to 50 pips, watching at the timings how the price behaves. Now often when we have a peak formation low or high in place and the market has had a down day, for example, or an up day, the 25, 50, and 75 increment levels will often be where the market will either consolidate for a reversal and then a follow-through measured move through a peak formation low or high, or the market will have already put a peak formation in, taking out a previous day low or high for a move in the opposite direction. So there are different scenarios that can play out, and we can relate to that depending on where we're at in that Monday, Tuesday, Friday, Monday, Tuesday, Wednesday initial balance scenario. But one of the things to pay particular attention to each and every day is when the market has moved to a 25, 50, or 75 pip increment level from the previous day or the most recent peak formation. So we're going to look at some examples to clarify that, but we'll review this in our simple system again. People often say, you know, it's too much information or it's too complicated, but there's a layer upon a layer upon a layer. And once you start to see this, you don't have to think about everything. It becomes unconscious competence. So we work from the high and the low. If you took a completely blank chart and just drew your highs and lows in, they would often show you where the best trades occur. But the problem is that most traders will sit around and wait for those moments to happen. That's why we pay particular attention to the timings, because often those timings will have either had a stop hunt near the high or low of the day. But one of the easiest ways that I pay attention to that is I will set an alert, as I mentioned before, 25 to 50 pips from a previous peak formation low or high. That alerts me to that market now being in a potential measured range where we can look for a stop hunt or a reversal to occur, or in a trending market for a possible measured move if we've pulled back or broken out of a trading range. So breakouts will often occur in trending markets. We will take out a previous day's high or low, and then we'll often see a pullback. Most pullbacks are 25 to 50 pips. Now the easiest, and what I mean by that 25 to 50 pips is not from high to low or from low to high, but the increment boxes of 25 and 50 pips from where that peak formation occurred. And again, we'll go through some examples on the charts, but when you start to pay attention to those levels, that's when you ask the question, how does price behave? What time is it? Are we at round numbers? Of course we are, because that's what we're using. Near the high or near the low of the day or the session. Do we get an engulfment or a pin hammer? Now in some cases we'll get an initial burst or a pullback or breakout, but that sometimes is what will allow us to create a middle structure. So sometimes we'll get a middle structure for that reversal formation off the low for a W or a double bottom, or we'll get a peak formation middle structure for an M pattern or a double top for a reversal. That will often be accompanied by a pin hammer, because that pin is the last stop hunt into the trader who's got the right direction, and the market's going to shift away. We have a 1-bar stop or a 1 ATR stop. Somebody asked a great question. What do you mean by 1 ATR stop? Well, the average range on most of these pairs for a bar is around 15 to 20 pips. When you factor in the spread and a couple pips either side, depending on where your fill is, your average stop should be in the area of 20 to 25 pips. Sometimes it's going to be 30, but it's more important about identifying, have they locked in the high or have they locked in the low for the move back in the other direction, or for a trend trade, meaning that they're done doing business above or below your position, and you lock in your stop, you have a measured move for your profit target, and again, depending on where you get filled, that profit target may be 50, 75, or 100 pips. So, really important. And if you identify the peak formation, and then again the pullback or the breakout pullback for a trend trade, that's when we can start to target if it's going to be a measured move. And then we measure from the numbers, because you'll get peak formations around the numbers, and sometimes that can create a bigger target that the market doesn't quite get to. But if we use the number boxes, in most cases the market will fill those prices. So instead of targeting 50, we might get 75, we might get 100, we might get more. So it's really critical to just keep it simple, meaning work from the numbers. But when we get a peak formation high or a peak formation low, if the market had a down day and gave us a peak formation low and then pulled back and went into the close, we might be looking at price action that goes 25 and then 50, and in some cases it might pin up to 75, but the trade occurs at 50 pips above the peak formation close, but even the low now we might be targeting 75 or more pips. And that's where you can step back and just look at the levels and know that even though the price action may be moving around, that you're identifying that the stop hunt has already occurred. The pullback in a lot of cases is actually a stop hunt into traders who have already in profit, but it's gone back to hit break-even stops, or traders who have trailed that market down using a trailing stop. And again, one of the things, always ask yourself, who is in profit and where is the money? Because the market, through its natural movement, is going to go back hitting liquidity, filling liquidity. It's going to go and hit stops. They could be take profit stops, they could be break-even stops, they could be trailing stops, all of those things that there's orders floating in the market, and of course there's large pools of orders above and below the high of the day. But every time the market moves 50 pips, start paying attention to the timings, and then if we get another 25 pip stop hunt or movement, pay very close attention, especially if it's a pullback and a previous day's high or low has not been taken out. If the market has extended the range and put a peak formation in place, we could be looking at a reversal situation. So even though the market's moved 50 to 75 pips from a peak formation, we may be now in a breakout pullback for a continuation trade in the opposite direction. What that means is that it's not a continuation with a trend trade. The market has flipped the book and they're going to do a stop hunt trend trade back into the existing larger trend. So we'll look at a couple of examples. Keep it simple, traders. And again, just focusing on high and low of the day, 25 and 50 pip increments from where that market's closed. We might get a pin up into that third box for a sell signal, 50 pips plus from the low of the day, and vice versa for the long trades. Timings are critical. It's always about the timings and the numbers. Simplest way to understand is, are we up high when the market opens in London? Are we down low? Has the previous day's high or low been hit? If not, how far have we pulled back? And are we looking for a trend continuation, or are we breaking out in the direction of the trend and possibly looking at a reversal type setup? We talked about this on Friday, level 3 on Thursday, but again, it's a new week on Monday, so we could be seeing some large moves tomorrow and Tuesday. We've got some pretty big market ranges that have been established last week. So we start measuring and looking at how the market sets up in Asia, and then we start doing the count. How many boxes has the market moved? Are we moving away from a peak formation? Have they taken out a previous day's high and low? Trend trades, reversals, continuations. Keep it simple, traders. Let's look at some examples. Again, thank you for a ton of emails and some absolutely great results by some traders. Very exciting. This week's going to be, I think, even better. So large trades, but keep it simple. Master 50 pips a day. Keep getting better at mastering your process, yourself, your daily preparation and routine. 1% better a day. Have a great trading session, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading. Just continuing our discussion on breakouts and pullbacks and looking at 25, 50, and 75 pip movements from the peak formation. Paying attention specifically to the timings, where we're at when price reaches those levels, and how price behaves when it reaches those levels. This can help us form a bias or a thesis for the current session that we're trading, and then position ourselves obviously either for a trend trade or a counter trend trade based on that information. So essentially every time the market moves or sets up a peak formation, low or high, it will move 25 to 50 pips, and in some cases 75 for an extended stop hunt or pullback into a trend. Or if it's reversing, that move will continue and then pull back weekly into the move for the continuation of the trend trade. You can back test this on any of your pairs just to identify. You'll see the similar peak formation types of setups. And then of course we're targeting measured moves for those continuations or reversals. So just looking at the pound Swiss, it doesn't matter where we start. We can scroll back to any time frame, any day, doesn't matter. But each day we go into the market, we look at the close, and then we look at how the market sets up. So we're looking to identify peak formation high. And then we're targeting our timings. And actually we'll just extend this back out for a few more 100 days. Then that allows us to look at what's happened at that from the peak formation. So in this particular case, the market has gone sideways, dropping down in Asia and then going up. So the market has actually gone to the high of the day at the beginning of the 12 candle Europe London window. Then it proceeds to drop down 25, and it attempts to go to the 50 pip box, 50 pips from the peak formation high, but it goes sideways. And so if traders were looking to get in at that 50 pip increment below, the 50 pip box below, the market did not allow us to get that, but it gave us an engulfment at the 25 pip box level and a pin hammer. So again, remember, our thesis is 25 to 50 pips is a normal stop hunt or pullback, whatever you want to call that. The market puts in a peak formation high as we head into the Europe-London session, drops 25, no trade signal. So we're expecting it to be down at the 50 pip box. The market gets to the low of the day and goes sideways. We get an engulfment and a pin hammer for a 50 pip move or greater to the high of the day. So when we talk about using measured moves, this market, essentially I like to use numbers in some cases, because often if you put that measured move beyond just peak formation to peak formation, the market doesn't quite get there. And that's actually a 50% extension. But then even if we use this peak formation now and pull back 25 and 50 pips, we use the same information to determine, is this evidence of a reversal or a continuation? So the next day we head into the session, we see the market has dropped 50 pips, but now we're actually in a trend trade, and the market now extends down 75 pips before pulling back numbers, and then continuing the move through for the measured move. So an example of a trend trade. And in this particular case, again, just going numbers to numbers, just for a measured move of this pullback, we get the 75 pip move down. But coming back to our original thesis, we have a peak formation high. The market drops 25 and then 50 pips. No evidence of a reversal. It gets to the low of the previous day and actually breaks through in our 12 candle window at double zeros before continuing down 1, 2, 3, then pulling back into the double zeros, 1, 2, sideways, 3 pin hammer for the continuation down. So again, 25 to 50 pips from a peak formation is a normal pullback, stop hunt, continuation, whatever you want to call it, and then we watch how price behaves. The difference here, the market drops down and goes sideways, gives us an engulfment and a pin hammer for the reversal. The next day, it drops down and goes sideways and continues the move. Hits the low of the previous day and continues even further. That's not a stop hunt, false break reversal. That's a trend trade, breakout, pullback, continuation. The next day, we follow this market. Doesn't give us a peak formation. It gives us continuation into the next day. Pulls back into the 25 pip box. It goes sideways. We fail to get to the 25 pip box above. The market, again, if we just look at straight breakout, the market breaks out, pulls back, re-hits the low, pulls back to the redrawn high of the day, drops down again to hit the low of the day. So we haven't had a 25 to 50 pip move in either direction. Then the market eventually, in the gap time, drops down into the lower 25 pip box. So if our original destination was 25 above or 25 below, the market initially gets to the 25 pip box below before pulling back. We get an engulfment on the low bear. The market goes sideways in that 25 pip box in the US session 12 candle window before moving up towards the 25 pip box above. Now, what's important about this information, especially on this particular day, it being a Monday, again evidenced by our pink line, is that we could be looking at a market now on a Monday that's potentially flipping the book from a down market, at least in the short term, 25 pip extension before pulling back. The next day, we have our peak formation low. We go 25, 50 pips. We're now at our 25 pip box from the previous day's session. We'll just move this line across. And what does the market do? It breaks through, and now we're 75 pips up in our Europe London window, and the market pulls back 1, 2, 3, hits the high again, pulls back 1 sideways, 2, 3, and then continues for the trend trade. Whenever we have a high or a low in the trend trade, we look for the measured move, breakout, pullback, continuation, and we see that market moved up 2 levels. 25, 50, almost 75 as we head into the Europe-London 12 candle window. But the market, Friday, Monday, Tuesday, again our initial balance, this market did not give any evidence of a 3-push pattern sell high setup for a return to Monday's low. Instead, it extended up almost 75 pips before going 1, 2, 3 into our 12 candle window. This is essentially a reversal rail engulfment pattern. And then we head into the next day. We get a peak formation heading into the close of the session. So again, even prior to looking at this, we're looking at our 25 pip box, our 50 pip box, and if the market was to push up, we could be 25 above and of course 50 pips above. The market stays sideways, and again, high of the day, low of the day. In our 12 candle window, the market heads through 1, 2, 3, drops back down sideways, bullpen hammer for the breakout. And again, now we're through the 25 pip box, pulls back, drops down through the 50 pip box as we head into our US 12 candle window. And then we have our engulfment and a pin hammer for the trend trade down. The market doesn't move that much heading into the close, but we head into the next day. We get our peak formation low in our Asian session. The market moves up 25. We'll mark this off, 25. 50 pips, pins up into the third box, but again 25 to 50 pips. In our 12 candle window, how does it behave? We get an engulfment. The market drops down, creates a middle structure before stop hunting towards the high of the day again, but again focusing on our original thesis as we head into our 12 candle window, peak formation, and then 25 to 50 pips. It gives us our upper double top structure for the sell in the US session. Peak formation high, 25, 50 pips to the low of the day. It's obviously more than 50 pips, but 225 pip boxes before giving us a peak formation low. We pull back into consolidation. We have our 25 pip box and our 50 pip box. Where does it go? We head into our 12 candle window. The market gives us our double top structure, sells off to the low of the day. We don't get our 50 pips, and that's okay. It goes into consolidation. What are we thinking? We're thinking 25 doesn't get through to the 50. It goes sideways, gives us a middle structure, and then we get an engulfment at the low of the day for a 50 pip move up. We have our peak formation low. So then we have our 25 and our 50 pip box for the next session. We head into our next session. And as we head into our 12 candle window, the market pushes up to the top of that 25 pip box, which is our second box, our 50 pips from the low, for the engulfment reversal and the move back down through the low of the day, as well as the previous day's low. If we do a measured move, low to high, we get more than 50 pips. And again, traders may trail these. I often will target the numbers. So if I'm looking at I'll just fix this. 250 pip boxes. So we're looking at least 75 pips. And this move gave us another pullback and reversal for a continuation for a measured move for more than 50 pips. But again, each time, we get a peak formation low. So we're looking at 25 to 50 pips as we head into the next session. The market goes sideways, 50 pips from the low in our 12 candle windows. The market breaks down at the end of the London 12 candle window before pulling back 1 push, 2 push, 3 pushes. Engulfment at the US session 12 candle window. And again, reinforcing our peak formation low, 25 pip box, 50 pip box, and then watching how the market behaves as we head into the next day's session from the consolidation. The average stop hunt or pullback is 25 to 50 pips, but we watch how price behaves when it gets to those levels. Clearly, the market is respecting the double zero boundary. This is what helps us form our thesis, and then the geometry, the structure, The number levels can help us identify measured move targets for 2 times the box as opposed to just randomly seeking 50 pips. So again, we go into the next day's session. The market's sideways. We get a peak formation low. This scenario is typical for a reversal pattern because the peak formations are on the continuation on the bottom facing up as opposed to on the top facing down. So we have our 25 pip box. We have our 50 pip box. 3 levels obviously can extend up. Oh, we lost our lines again. Okay. And our 3rd level of rise. Market goes sideways. Peak formation 25 and 50 pips. At the end of our 12 candle window, we head into the US session. We get the engulfment, the doji pin, second stop hunt on the guy that got the trade right, and the measured move back down. So we had our peak formation low, and then 25 pips above, 25 pips above, 25 to 50 pips above the peak formations or below the peak formations. So we look at this peak formation low here, and then we identify again our 25 pip box, our 50 pip box. And as we get closer to that trend exhausting, those ranges can get tighter because the market will tend to blow off in the direction of the trend. And again, sideways inside of that trading range. We have a rectangle forming in a 50 pip box. This is market generated information. There's nothing that we don't need to argue about. Market moves up above the box, giving us our M pattern structure before pulling back inside, consolidating at the mid-range of that rectangle, pulling back and continuing down with a pin hammer engulfment just prior to the US session 12 candle window. Peak formation low on the Monday. So we identify again our 25 and 50 pip box. We have the peak formation is on the bottom. So we have a couple scenarios. It's a Monday, and you guessed it, trend trade. Market breaks above the 25 pip box at the end of the 12 candle window before pulling back 1, 2, sideways 3, and a continuation. 25 to 50 pips. We mark these off each day. That helps us identify if the market is bouncing off of those levels, extending into them, or finding resistance or support as we head into each 12 candle window. This is a great example. So we have our range and we look at 25 and 50 pips above the consolidation. And this helps traders identify where this trade may fail or work or continue. Market auctions down 1, push 2, push 3 pushes. We head sideways, pin hammer, engulfment, pin hammer in the US session 12 candle window. 50 pips from the peak formation, 125 pip box below for the 50 pip move back up to the high of the day. So hopefully you got some value from today's video, traders. Breakouts and pullbacks, 25 to 50 pip boxes above or below the peak formations. This can help us identify our thesis for the day for either a continuation trade, a reversal, or a trend trade. Stay disciplined, traders. Stay focused. Keep it simple. Use market-generated information. Timings, high of day, low of day. Have a great trading session this week. Keep it simple. Start the week on a strong note, and may the markets go
Hi,
with
traders. It's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments, As always, traders, stay disciplined and may the markets go with you.